$300 billion. That's not just a number on a screen, nor is it the GDP of a mid-sized sovereign nation. It represents the implied volatility that Wall Street has to digest the moment the opening bell rings. Right now, the direction of global liquidity has decoupled from Federal Reserve interest rates or White House policy. It has been hijacked by a single ticker symbol. Think of it this way. We are essentially placing the combined market capitalization of three Intels on the poker table for a binary bet. This is the macroeconomic reality of the week. Nvidia's earnings day. Let's correct your framework. This isn't just a quarterly earnings sheet. It is a systemic stress test for the entire AI asset bubble. Current valuation multiples have stretched liquidity to its absolute limit. In this report, it is the potential catalyst that triggers mean reversion, the inevitable return to reality. Today, we're going to dissect this $600 billion source of volatility within our valuation models. This isn't about complex math. It's about market structure. We need to tune out the noise and examine risk exposure like an institutional trader. In a casino dominated by high-frequency algorithms, the only rule that matters is execute an effective exit strategy. First, let's step back and assess sentiment indicators. Current bullish sentiment is bordering on irrational. We have entered the mania phase. When retail investors in Manhattan and the degens on Wall Street bets are all crowding into the same trade, that is a classic overcrowded signal. Why is this lethal? Because it invokes Wall Street's cruelest pricing law, priced for perfection. In quantitative terms, over the past year, Nvidia hasn't just beaten expectations, it has reshaped the benchmark. Now, buy-side analysts are incredibly demanding. Simply beating earnings per share EPS isn't enough. The market has already priced in the most optimistic scenario for the next 3 years. An infinite total addressable market, flawless execution, and zero competition. In finance, we focus on the second derivative of growth acceleration. The market stops looking at absolute profit figures and starts staring at whether the acceleration is slowing down. It's like driving a Ferrari on the highway. 200 miles per hour is the baseline expectation. But if that acceleration drops even slightly, even if you are still speeding up, the algorithmic bots will immediately trigger a sell-off. If Nvidia hints that growth is 1% slower than last quarter for current multiples, that is a valuation re-rating disaster. The margin for error is zero. Let's dive into the fundamentals. Let's talk capital expenditure. The current AI boom is essentially an arms race between Silicon Valley's Big Four, Microsoft, Google, Meta, and Amazon. They are trapped in a classic game theory prisoner's dilemma. If you're Google CEO Sundar Pichai, do you know that the current ROI on AI is negative? Of course. Current revenue streams cannot cover infrastructure costs. Do you want to cut capital expenditure? Absolutely. Your CFO warns you about cash flow pressure every day. But you dare not stop. Because if Satya Nadella keeps stacking computing power at Microsoft, Bing will algorithmically outmaneuver you and dismantle your search moat. This is defensive spending purely for survival. So despite margin compression, they are forced to transfer hundreds of billions of dollars annually to Nvidia's balance sheet to buy expensive H100 and Blackwell GPUs. Nvidia, as the monopoly supplier of these shovels, enjoys the premium. However, there is a macro mathematical hole here. Sequoia Capital has already sounded the alarm. Look at this core data. To justify this hardware capital expenditure, the AI industry must generate about $600 billion in incremental revenue annually. Note that figure, $600 billion. But reality is disconnected. If you total all global AI software subscriptions and API revenues, it's only a few tens of billions. There is a revenue gap of over $500 billion. It's like investing $1 million to build a restaurant, but your daily cash flow only covers selling a few hot dogs. This is what we call a valuation bubble. Current buying is based on discounting the future, driven by a capital expenditure cycle fueled by fear. Tech giants fear falling behind, retail investors fear missing out. But the risk is, this fear is unsustainable. Once Wall Street demands to see free cash flow conversion, if just one giant, say Meta, decides to cut next year's capital expenditure guidance, Nvidia's order book faces default risk. This is a systemic risk of excessive customer concentration. Beyond commercial logic flaws, Nvidia faces two specific tail risks. First is the physical bottleneck. All eyes are on the latest Blackwell architecture. This is their core moat. but supply chain intelligence suggests a thermal design power issue. The chips are generating heat at rack densities that could lead to overheating. This isn't a simple assembly issue. If the cooling solution fails, it means redesigns and delivery delays. In tech, time to market is everything. A 3-month delay gives AMD a window of opportunity. This would directly hit Nvidia's high gross margins. Once gross margins mean revert, the valuation model collapses. The second headwind comes from geopolitical risk in Washington. We are on the eve of the Trump 2 era. Investors must factor in macro policy risks, tariffs, and trade protectionism. Nvidia's supply chain is highly globalized, designed in California, manufactured by TSMC in Taiwan. If trade barriers escalate or new export controls are implemented for national security, critical revenue sources could be cut off. This is an asymmetric policy risk that candlestick charts cannot predict. Hearing this, your risk aversion might be spiking. You might be thinking about liquidating your positions and holding cash. No, that is not the professional approach. In financial markets, volatility equals opportunity. What you need is risk management, not panic. Here is the institutional grade playbook. Rule number 1, avoid the gamma squeeze. Do not gamble on options before earnings. Absolutely not. The get-rich-quick stories on Reddit are pure survivorship bias. During earnings season, Nvidia's option implied volatility is sky high. The market has already priced in massive swings. To profit, the stock must move even more violently than expected. If the report is positive and the stock rises 5% but fails to meet the implied volatility expectation, you will still lose money due to volatility crush. Do not pick up pennies in front of a steamroller. Rule number 2, the core satellite strategy. This is standard configuration for hedge funds. Allocate 80% of your capital to core assets, the S&P 500 or NASDAQ 100. This captures beta returns. If Nvidia rallies, the index benefits. If it crashes, the index's diversification protects your principal. Use the remaining 20% risk capital as satellites to chase alpha. Allocate this to Nvidia stock or a semiconductor ETF. This is an asymmetric bet. Limit downside risk while retaining upside explosive potential. Rule number 3, hedge via utilities. If you think tech valuations are too high, look for second-order beneficiaries. Regardless of who wins the AI model war, one thing is certain: AI is a massive energy consumer. Future data centers are essentially power plants with computing functions attached. Go long on power infrastructure. Focus on utilities and nuclear energy sectors like Vistra Energy or Constellation Energy. These offer high certainty. In a gold rush, the steadiest strategy is selling water, and in the AI era, electricity is water. Rule number 4, strictly execute a trailing stop. If you hold Nvidia and have floating profits, congratulations. But don't let greed take over the trade. Set a trailing profit take. No one can predict the top, not even Jensen Huang. Set a 10% or 15% pullback trigger. If the price drops 15% from its high, an algorithm automatically executes the sell. This way, you capture the upward beta trend while locking in profits. Don't fall in love with the stock. Use technical tools to eliminate emotion and prevent huge unrealized gains from turning into losses. Finally, let's talk market psychology. Staring at the quote screen, it's easy to suffer from FOMO, fear of missing out. But remember the lessons of historical cycles. Cisco Systems in the year 2000 was that era's Nvidia. It was the king of internet infrastructure, the most valuable company in the world. The result, after the bubble burst, it fell 80%. Even though it remained a great company, it took 20 years for the stock price to return to its highs. If you buy at the peak of a valuation bubble, the cost of time is enormous. Great companies do not equal great stocks, especially when the price has already overdrawn the next decade of cash flows. In a market full of noise and algorithmic gaming, your most valuable assets are discipline and patience. Block out the emotion, trust the data. In this feast of liquidity, only those who keep an eye on the exit can keep their winnings when the music stops. That is this week's trading strategy. Remember, capital preservation is the prerequisite for any comeback. Good luck.